All right. So this section of consolidation will look at how to prepare the consolidated financial statement. So we look at the process of preparing consolidated financial statement. All right. Now, the first financial statement we want to learn to prepare is the consolidated statement of financial position. Consolidated statement of financial position. All right. Now, from our journey from IFRS 10, and particularly the timing in consolidation where we learned about IFRS 3, the first thing we need to do is to actually set out our workings, and you set out your workings. So our workings, we learned from our previous study about IFRS 3 acquisition method that we need to identify the acquirer and the acquisition date and sort of the control that they have. So our workings, remember we said that we talked about it. Our workings, one is determining our group structure. And you need to do that in your exam. So you have to always determine the group structure. Why? Because it is required by IFRS 3. All right. It's not that you just do the workings for the working's sake. It is actually a depiction of your IFRS 3 accounting method. It's just that at various centers, what we do is that we just let you run by it or do the workings. But there is a reasons why you do the working. There are the reasons for the workings. And the reason for the workings is because of IFRS 3 business combination acquisition method account. So what goes into your group structure determination? Okay, so this is basic consolidation. So you will need the parent. To find the parent, remember, it says that identify the acquirer. Now, if you identify the acquirer, then you identify the acquiree, which is the subsidiary. Now, you need to be able to express what we call the percentage of control. You need to show it. Okay, you need to show it. So if the percentage is 80%, show it. So controlling interest is equal to what? 80%. You need to show it. If it is 51%, show it. All right. Then when you do that, don't forget that IFRS 3 business combination also said that we need to also identify the acquisition date. So here you have to also show the acquisition date. The acquisition date. You have to show the acquisition date. It's very, very crucial. So also show the acquisition date in your workings one. Acquisition date. Now, determine the timing from the acquisition date to the reporting date. You have to always do that. Why? Because you realize in your workings too that we will need that for our fair value adjustment, amortization or depreciation. So what is the range, the timing between the acquisition date to the reporting date? It can be 2 years, it can be 3 years, it can be 5 years. You see, a company can buy another company, but decide not to consolidate until after 10 years. Yes, because probably certain things has not been done yet. So they are in the process of getting listing or whatever it is. So you need to determine the timing to the consolidated date or the reporting date. So find out, always put it there, the timing to the reporting date. All right, always put it there. The timing to the reporting date is important. So you put the acquisition date and you check maybe the date it was acquired and the date you are doing the consolidated financial date can be 3 years. So you put 3 years. If it is 6 months, you put 6 months, okay? Whatever. So for example, if you say A bought 60%, A bought 60% of B at or on 1st April 2022, and the reporting date, so the consolidated financial statement, consolidated SoFP, is to be prepared on 31st December 2020. Then it means that our group structure, workings 1, will look like this. So workings 1, group structure. Will look like A, which is the parent, then the B, which is the subsidiary. Then we will show the percentage of control. In this case, it is what? 60%. Okay. When was it bought? The acquisition date will be 01/04/2022. Now, what is the range to the reporting date here? So we have April, May, June, July, August, September, October, November, December. So you could see that it's 9 months, right? So you write here 9 months. Crucial. So this is how your workings 1 will look like. Please, any question on the workings 1? Any workings on the workings 1? Any question on the workings 1? All right. So that is how it will look like. Then, when we are done, we move on to our workings 2. Workings 2. Workings 2, if you remember what we said in acquisition method, was to do what? Fair value of the net assets of the subsidiary. If they buy 10 subsidiaries, you will do it for 10 subsidiaries. You do Obianene one by one. So you do like that. You do the process for everybody. All right. Not the workings 1. I'm talking about the workings 2. If they buy 10 subsidiaries, you do it for 10 subsidiaries. So here will be fair value of net assets of each subsidiary. So each subsidiary you have. Okay. At acquisition date, so you do that. And because you'll be preparing financial statement, the consolidated SoFP, this one is good. So some people decide to do only the acquisition date, then they use it to determine their goodwill also. So that is how some of the manuals presented. But to make your job easier, as you preparing a consolidated financial statement, not only will you do it for the acquisition year, also do it for at reporting date, because you'll be preparing consolidated financial statement at reporting date. Then post-acquisition. All right. What goes in here don't forget, is net asset, the fair value of net asset. So what goes in here is your key one, is your share capital. So you start with your equity or share or what we call stated capital, all right, or stated capital. All right. So you figure out from that, you figure that one at the acquisition date, figure that one at the reporting date. And most of the time, share capital doesn't change. All right. It doesn't change. So the difference, the movement will be 0. Then you come to your reserves. Your reserves. When we talk about reserves, reserves start from share premium. Your share premium. So that one too, you look at it. Sometimes there may be a change in that. There may not be a change in that. So if this one moves, the difference will come here. So let's say here was 10,000 and here becomes 2,000. Then 10,000 and 20,000. You get a difference of 10,000. All right. It's possible. It's very possible. But if it doesn't change, then it means it's 0. If here is 10,000 and here becomes 5,000, then it means the change is negative. All right. So that is how you check it. All right. Then you have some other things like other component equity, like revaluation surplus. If it happens in your exams, if you see those things, these are how you place them. Of course, revaluation surplus, you will definitely see a movement. All right, that one you definitely see a movement. Then we have almighty retained earnings. Okay, your retained earnings. At acquisition and at reporting, you will also definitely see a movement. All right, so that is that. Then once you are done with these things, you go back to what we've discussed. For example, inherent goodwill. If there is something like that, all right, if there is something like that, remember it is an inherent intangible asset. Remember what IAS 38 says. It says that we should write it off. So you write it off at the acquisition date and you write it off at the reporting date. So you see a nil here. Then we said in the interim, the things that happens in the interim, if you remember in the timing, I spoke about so many things. Example will be fair value adjustment, the fair value adjustment. So if there is any fair value adjustment, and here be careful, here, depending on what the adjustment is on. So if the adjustment is on land, it's a PPE. So it will be land. At the acquisition date, it will be land. The fair value adjustment will be land. Now, the adjustment can be a positive adjustment or a negative adjustment. So please take note of that. Be a negative adjustment, can be a positive adjustment. All right. So now, if the adjustment is about land, your initial measurement is what you have at the acquisition date. Now, your subsequent measurement, we don't depreciate land. You know that. So please, if the adjustment is here, you find the adjustment. The question will always tell you the adjustment. All right. It will always tell you the adjustment. If it is positive, if it is negative, manage the adjustment out. Now, every adjustment has subsequent measurement. So what brings it to the subsequent measurement can be a fair value adjustment depreciation, fair value adjustment depreciation, or it can be fair value adjustment impairment, or it can also be fair value adjustment amortization, whichever one it is. So for example, and it always affects the subsequent measurement. For example, if the fair value adjustment is a land, there will be nothing like subsequent measurement because land is the same. It doesn't change. You don't depreciate land, it can suffer impairment, but hardly, or amortization, you don't amortize land. But if the fair value adjustment is on PPE, let's say building, you know that there will be adjustment on it. You know that definitely you will depreciate the building. Now, your depreciation here will be the carrying amount or the difference of the adjustment. So the adjustment divided by the remaining useful life, then the timing that you did here. So this case here, 9 months will be what you will use. So if the acquisition was within 9 months to reporting date, then it means your adjustment will be affected by the date, the time period you put here. That is why it is very, very important. So if here is 10 years, your adjustment will be multiplied by 10 years. If it is 1 year, it will be multiplied by 1 year. So please don't joke with the thing you have to put here. Don't joke with it because it has a bearing on your fair value adjustment. Okay, so if it is depreciation, you will do it. Now watch this. If it is a positive, your adjustment should be a reduction. So it's like this. If it was negative, your adjustment should be a positive. It's always the inverse. All right, take note of that. So this one is 0, this one is, so the movement will be as you see here. All right, take note of that. Okay, that is that. Now, if there is any uniform accounting policy adjustment, you do that. But most of the time, so let me say uniform accounting policy adjustment. So if they are changing accounting policy, which is IAS 8 adjustment, you adjust it too. All right. So that is that. Now we come to the provision for unrealized profit. But let me stay here for a while because you see, this fair value adjustment can be on receivables. It can be on inventory. And you do know that at the end, the inventory, the subsequent measurement, which is at the reporting date, should be the lower of cost and what? Net realizable value. So at the reporting date, depending on what was adjusted, the standard of what was adjusted comes to play. So please take note of that. It's very, very important you understand that. If what was adjusted was IFRS 9, remember IFRS 9, impairment on receivables. Okay, you put it there. All right. So that is that. You use the standard of that particular adjustment. So we will be practicing questions, and I believe you will see that. Then the key to one, the last one will be your provision for unrealized profit, your PAP. Your PAP, provision for unrealized profit. Like I've told you, PAPs, we have 2 PAPs. We have PAPs on inventory. And don't forget, everything we are doing here is about the subsidiary, not the parent. Workings 2 is for the subsidiary. It is not for the parent. I repeat, workings 2 is for the subsidiary, not the parent. All right. So when we talk about the inventory PAP here, and the inventory PAP is the one that will come here in terms of the inventory, or not everything. In terms of the inventory, it will be if the subsidiary sells to the parent, if sub sells to parent. Okay, so that one will be here. You are removing the profit on that, so you remove it. That's the PAP. All right. What about if the PAP is PP PAP? PP PAP. This is where it gets a little bit tricky. The PP PAP, if the sub sells to P, to the parent, you repeat the same process as the inventory. So here will be dash, dash, nil, nil. Repeat the same process. However, if the parent sells to the subsidiary, it also comes, there will be excess depreciation. And that one here will be a positive figure. Positive figure. It won't be a deduction. We will show you that. We will deal with that. But for now, this is your exemplary format for your workings too is plenty, right? So you need to learn them anyway. So you total everything here. And total everything here. And total everything here. All right, now watch this. And you need to get this thing by understanding. This one, the figure here, the name of that figure is the fair value of net asset of the subsidiary at acquisition. Why am I saying that? The examiner has been cunning sometimes. He gives this figure directly sometimes. So he will tell you that at the date of acquisition, the fair value of the net assets of the subsidiary was so and so figure. So he has given to you already. Now, when he gives you to you already, you realize that there is still stated capital. You have to do this. There is still share premium or probably everything here. But you will realize that something will be missing. Like the way we did our cash flow, something will be missing out of this thing. And most of the time, that thing that is always missing is the fair value adjustment. Because he has given you the total already, and he will give you some of these things too. So you realize that most of the time, it will be the fair value adjustment. And additionally, the fair value adjustment depreciation. So please don't just follow procedures, understand what you are doing, because I have seen, especially those in level 3 doing corporate reporting, they are stuck to this formula. Okay, so this format, so that even that when the examiner actually gives them this figure, they don't see it. He will give you the fair value of the net assets of subsidiary at acquisition. And that is what you were looking for. It is all the amount that he has given it to you already. Then it means that you need to just put it there and find out which one was missing out of it, like the way we do cash flow workings. All right. So that is that. So what we will use these totals for are, we will use this side to continue to do our workings 3, which is goodwill determination. And we will use this side to also to do our workings 4 and workings 5. You will need it. All right. So take note of that. Now let's go to our workings. Our workings number 3. So workings, are you copying? Should I leave it there for a while? Or you have it in your manuals already? So I should move on. All right. Silence means move on. Okay. So we now come to our workings 3. Workings 3, don't forget, IFRS 3 taught us that we should do workings 3, and workings 3 was the determination of what? Goodwill. Determination of goodwill. All right. Goodwill. How do we find goodwill? We will need the purchase consideration. Okay. You see, goodwill, when you buy something from someone, let's say the thing is, you buy something from someone, like you pay 10,000. And to the person, the actual cost of that thing was actually 8,000. So to him, when he sells it to you at 10,000, it means he has made a profit of 2,000. But to you that purchased, you think that you also saw something that the seller didn't see. So that 2,000 becomes your goodwill. So it is the difference between the purchase consideration and the fair value of net asset that you acquire. All right. Okay. So now, how do we go around this? So you will need, therefore, the purchase consideration. So the fair value of your purchase consideration, what you are paying and you have a whole tuition on this purchase consideration later. So you will need the purchase consideration, and you add the part that you didn't buy, the NCI at acquisition. Don't forget, I told you that we have the fair value method and we have the proportionate method. So depending on the method. Now, what is the difference between these two methods? The fair value method will be given in your exams. If that is the one that you have to use, it will be given to you. So that one is cheap. It will be given to you, just pick it. But when the question doesn't give it to you, then it means that you are going to use the proportionate method. Or the question can even state emphatically that they use the proportionate method. But if it doesn't state it, and again doesn't give you the fair value, then it means that you are going to use the proportionate method. And how do you use the proportionate method? The proportionate method is the percentage of the NCI, the part that you didn't buy, multiplied by this one, your working 2 here, the fair value of net asset at acquisition. So if you get it wrong here, it means whatever you are coming to do here is also wrong. So multiply by what? Fair value of net assets of subsidiary at acquisition. Please, did you get that? So you multiply it by that. Then you add them together and get the purchase consideration. All right. So you add them together. Then you will less the fair value of net assets of subsidiary of the subsidiary at acquisition date. So that figure that you proportionated it is the same figure that here you don't proportionate it. You are going to pick everything, and don't forget it is coming from your workings too. You are going to pick everything, the total, and deduct over here. When you deduct, you will get what we call goodwill at acquisition. So that is how you find the goodwill at acquisition date. All right. So that is that. So goodwill at acquisition. This is how you find it. So if it is fair value method, hallelujah, they will give it to you. Then you put it straight. If it is proportionate, then it means that you take the NCI percentage. So per the example that we've been using here, if the person bought 60%, then the NCI is what? NCI will be what? 40%.
40%.
Exactly. So in your workings 3, you are going to do the fair value of NCI here, NCI at acquisition. What you'll be doing in this case will be 40% multiplied by this figure here, triple Z. All right. So that is what will give you triple Z. That is what will give you your fair value of NCI. Now, then you will less the entire triple Z. Okay, you will less it. All of them, you will less it. So that figure there, fair value of net asset at acquisition, is very, very important. It's very, very important. So if you miss it, everything starts falling apart. All right. So be careful in your exams. Now, depending on whether it is proportionate method or it is not proportionate method, goodwill is tested for impairment. Now, remember when we were doing IAS 36, which was impairment, I told you that there are 3 conditions why you should by force test for impairment. Number 1, if you remember in those times, number 1 was what do we call it? Intangible assets without finite useful life is tested for impairment. We also say that goodwill, okay, goodwill from business combination is also tested for impairment. Then the last one, we said intangible asset yet to be made ready for use or for sale is also tested for impairment. So you see, those things we learn from the standard, it cuts across everywhere. So here, you will have to less any impairment. Please, this is the goodwill at acquisition. So if you want the goodwill at reporting, then you less impairment, goodwill impairment. That one too, the question will give it to you. You can say either a percentage of this goodwill or or what do you call it? The full amount of goodwill. But let me say this, because this part is very, very important. Before I even write this, let me just create a space, because there's something I'm going to tell you and it will have its place. So let's say less what? Impairment of goodwill, or let me even call it goodwill impairment. Goodwill impairment. Now, goodwill can only be impaired if the fair value method was used. This fair value method or full goodwill method. So fair value method only. So if the proportionate method was used, don't look out for any goodwill. All right. So that is that. Now, if the fair value method is used, it means that the impairment, which will, yes, of course, go to your P&L, all right, will be shared among the NCI and the CI, the controlling interest and the non-controlling interest. So if per this example we are doing, the NCI is 40%. So the 40% will go to, of this impairment will go to the NCI. Then 60% of this impairment will go to the CI. The same way, this figure that we had, where I told you that one will go to Workings 4 and one will, but don't forget Workings 4 is NCI. So this one will be 40% going to the NCI. Then Workings 5, we are going to use it for the CI retained earnings. So that one will be what? 60%. So you share it. We call it NCI share of post-acquisition profit. All right, the same thing happens here. However, there's something that I need to tell you is that when you use the proportionate method, of course, per the proportionate method, there will not be any impairment. When you use the proportionate method, the goodwill that you find, okay, the goodwill, so if you use the proportionate method, the goodwill that you are finding is the goodwill proportionate. Is the goodwill proportionate? Okay, so it is not the full, it is proportionate. So the question can also give you what we call the attributable goodwill for the NCI. So it will give you the goodwill proportionate for just the company, the parent. Because of that, look out in the question. The question can tell you to, it can give you a goodwill for the NCI. Because if the proportionate method was used, then it means that the goodwill you found is just proportionate to the parent. If that happens, they can give you what we call an attributable goodwill for the NCI. So look for, if you have any attributable goodwill for the NCI, you add it. All right, so you add attributable goodwill. And that I've said that comes via the use of what? The proportionate. So if any goodwill from the NCI, please add it here before you determine what your, so that case there will be, let's say, another ZZ here. Then you determine your impairment, all right, then you get your goodwill carry down. which will go to the SoFP. All right. So that is how your working straight looks like. That is how your working straight looks like. All right. So that is that. We are going to pick up a question and practice using what we are doing now. So we will determine the workings, then we will consolidate. All right. Then our workings number 4 will be, don't forget what the IFRS 3 said, acquisition accounting, will be our NCI. So that is our workings number 4. Now, before I go to the workings number 4, do understand that the goodwill can be negative or positive. It can be negative or positive. Now, so if you find out that your goodwill is positive like this, like the one you have here, that one is fine. It's going to your SoFP. We don't have a problem. However, so key point here, if this one is negative, the goodwill is negative, then we call it a gain on bargain, because like I said, is somebody selling something to you at 10,000 and making a profit of 20,000, 2,000. Now, if the person sold to you and the person made a loss, then it means you, the one that bought, you've made a gain. All right. So if it is a gain, what you will do is that you will add it to your workings 5. If it is a negative, we call it gain on bargain. We will add it to our workings 5. Please take note of that. Take note of that. Now, what if the goodwill impairment, you see, I said that is from full value method only, or fair value method only. If it is from that, then it means that you are going to share it. All right. So that is that. Now, if you have any impairment, that arose, but that goodwill, okay, so we say that if the proportionate method is used, then we will be sharing the goodwill impairment. Okay, sorry, the fair value method is used, we'll be sharing the goodwill impairment. But in some way, somehow, there is impairment, and yet it is coming from the proportionate method, then that one, it will not be shared. It will be given to the parent only. So please take note of that. Take note of that. This is what I'm talking about. We will pick up an example and we will do it. So first of all, I said that if you are using the goodwill method, then that one, the full value method, the question will give it to you. And the goodwill will be attributable to both the parent and the subsidiary. So that is that. Okay, so full method, the goodwill will be attributable. I mean, the impairment, you will spread it like that. Okay. However, if it is proportionate method, then it means that the goodwill is for the parent only. It's for the parent only. Take note of that. It becomes for the parent only. So if by chance there happen to be any impairment, okay, which is coming from the proportionate method, it is not shared. It is given to the parent. Because why? The proportionate method talks about the fact that the goodwill is calculated for the parent only. Only. That is why there may be an attributable goodwill here. So if you use the proportionate method, in some way there is a impairment on the goodwill, then please, that goodwill is solely attributable to the parent. All right, take note of that. Then the last thing we also said is that if the goodwill is negative, then it means that the fair value of net asset, all right, exceeds the purchase consideration, and therefore it's a gain in bargain. And that one, you will have to add it to your workings 5. So when we get to workings 5, we will push it there. So we won't do it like it's a negative. We won't even get to goodwill carry down. You just add it to your workings 5. All right, because it's a profit that you have obtained from buying something. All right, so now let's go to our workings 4, which is our NCI. Try and remember these things so that when we start the computation, you'll be able to apply them. So now we go to the NCI computation. NCI. All right, how do we do NCI? So wherever you've seen NCI, we are bringing them together to do the NCI workings, and that is our workings number 4. All right, then the last one will actually be our workings number 5. Then we will take up a question, like an illustration, and deal with it before we go in there and try to deal with the adjustments. Okay, so that is what we will do. We will just pick up a question and we will deal with it before we go in there and do some of the adjustments. Now, what we do here is that you will need the goodwill at acquisition, NCI. Sorry, you need the NCI at acquisition, fair value of NCI at acquisition. And of course, you've already seen it before. It was in your workings 3. So just go and pick it. This is it. The fair value of NCI or NCI at acquisition, depending on whatever method you had. This is it. All right, so you pick it from your workings 3 and you start with it. All right, you start with it. Then you bring in the NCI share of post-acquisition profit, post-acquisition profit. That one too was in your workings 2. So you would use the NCI percentage multiplied by that figure. If you remember, this was it. We come to your workings 2. This is it. This is it. So you share it. All right. So that one will come. So it means that your workings 2 is very crucial. If you get that place wrong, then you have a problem. Then if there is any allocated goodwill to the NCI, which I mean from the workings 3, we saw something like that. If there is anything allocated goodwill to NCI, which we saw in your workings 3, you add that one too. All right. Then we have, so we've done the NCI share of post-acquisition. All right. Now, then if there is any revaluation surplus, post-acquisition revaluation surplus, you can bring that one to NCI share of post-acq. If an asset was revaluated, so post-acquisition revaluation surplus, you add that one too. All right. Then the only thing you less will be what do we call it? Impairment. NCI share of impairment loss. Of impairment, goodwill impairment. All right. So goodwill impairment. Don't forget, it's only come from the fair value method. If it is the proportionate, I told you that everything will go to the parent. All right. So that is that. You less that. Now, in the question, so you can end here. You get your NCI here at NCI carry down. But in the question, if there is any preferences of the subsidiary, please, you can add it here. All right, preferences. Okay, so you can add that one here. It doesn't happen most of the time, but if it happens, add the preferential to the NCI. All right, so that is that. Preferential of subsidiary, not parental, of subsidiary. All right, so that is that. The last thing for us to do will be our workings 5. our workings 5. So we look at our workings 5. That's the last thing. So you pick up some figures and practice. So that one is the group retained earnings. So I didn't say group reserve though. I said group retained earnings. So there's a difference between reserve and retained earnings. So that one, you need the parents on. I mean, you pick the 100%. The parents retain earnings, everything 100%. You will need that. All right. This pen keeps misbehaving. Just a second. So you have that, the parents 100%. Then you bring in the same thing you did here, NCI share of post-act. So here will be CI share of post-act. Here we are talking about the controlling, the parent. So the CI share of post-acquisition profit, which comes from your workings too, right? Your workings too. So you will do the CI percentage, which in this case is 60%, right? In this example, will be 60% of that figure you had there. So you add it, all right? So if the subsidiaries are 80, you will do CI share of that 10, you do workings to 80 times and add those ones here. You do NCI to 80 times. All right. So depending on the question. All right. Then if the goodwill is negative, so negative goodwill, we said that you add it to your workings 5. So negative goodwill. Now, understand this, okay? This group retained earnings, you need to know what retained earnings is. Retained earnings is cumulative profit. All right. Now, this retained earnings in your balance sheet determination is a representation of your profit. Don't forget, when you are doing balance sheet, there is always at your equity side profit. So this is where you capture everything. Okay, this is where you capture everything inside. So everything that relates to P&L comes to this group retained earnings. All right, so don't forget that. So the negative goodwill, which is a gain for you, normally which will go to P&L, will come here. All right, don't forget that. Then we have the impairment. So the impairment, we say you share the impairment. All right, you share the impairment. So CI share of impairment when it is fair value method. But when it is proportionate method, everything comes here. You don't share, you bring everything here. CI share of impairment, of goodwill impairment. All right. So you deduct impairment. Okay. Then after you have deducted the impairment, we talk about the PAPs. So here too there is PAP. So PAP we have two. Don't forget we have the inventory. The inventory PAP. Of course, here will be when parent sells to the subsidiary. When P sells to SAP. When SAP sells to P for inventory, don't forget we treated it in workings too. But when parent sells to the subsidiary, that one will come here for inventory PAP. The same thing for PPE PAP. So the PPE PAP, if the parent sells to the sub, the same thing, you treat it like the way you do the inventory. However, if the sub sells to the parent, it will be a positive here. Don't forget, just as it happened the other way around here, when we were doing the workings two, when parent sells to sub, you see it's a positive here. So also when you come, and it happens for only in PP, all right? So PP to when sub sales to parent, it comes here also. So I will show you those adjustments when we look at the adjustment, why they are coming there. All right. We call it excess depreciation. All right. So that is that. Now, then there is unwinding finance costs. I will show you where the unwinding finance costs will be coming from. I'll show you that also when we start looking at the adjustment. So unwinding finance cost. When you PV something in accounting, especially a liability, there is always a unwinding finance cost. This one will come from the purchase consideration when they use a liability to pay, or when there is a deferred consideration. Okay, we call it unwinding finance cost. Anytime there is a deferred consideration, there is also unwinding finance cost. So that one too will come. You deduct. All right, then you get your retained earnings. Of course, you can also decide to bring in here CI share of what revaluation surplus. Okay, so you can add it here. If there is revaluation surplus, the parent share of revaluation surplus before the unwinding comes. Or let's just do the unwinding. And let's say if there is a post-acquisition revaluation surplus, the part that will go to the parent. So CI share of post-acquisition revaluation surplus. But the reason why I don't want to add it here is because revaluation surplus go to OCI. It doesn't actually come to P&L. So let me just leave it like that, all right, so that we will treat it as OCI item, all right, in our financial statement. If had it been, I've called this one a reserve, not retained earnings, I would have added it. This one is retained earnings. So revaluation surplus is OCI item. So let's leave it out here. So we get our total here, which is our retained earnings carried down, which is going to our SoFP. So now you can now do the OCI aspect will be the revaluation surplus, okay, the CI share of post-acquisition revaluation surplus. Don't forget the other part, all right, will actually go to the NCI. All right, so that is that. Now, these are the 5 main workings you do. So just a quick glance. We are going to use it to solve an illustrative question now. So take a quick glance, all right, just so that you don't forget them. Okay, so we started with our workings. One, when you draw your graph, the table here, or your diagram, and you show the date, you show this. All right, then you come to your workings to fair value of net assets, of subsidiary, the things, some of the things that goes in here, picture it. All right, we'll be doing it right now. Okay, then we have the goodwill also fully illustrated. Okay, then workings 4 is NCI. We have this. All right, then the last working is group retained earnings, and this is what we have. All right, so we are going to use it to practice an illustrative question, and after which I want to believe that you will keep practicing before we meet again next week. All right, so so that next week we will look at the adjustments and solve an exam type question. All right, then the rest is just consult P&L, nothing difficult, and an associate. All right, now let's look at an illustrative question. Okay. So everything we've mentioned here, all right, everything is in there. Okay. I think here the adjustments are dealt with before the illustrative questions. But let's see. Let me look at this. This illustration 8. Okay. There's not much in there. So let's look at the illustration 8. Okay. All right. So now we have a company here. Pine Company acquires 75% of the ordinary shares of Sequoia Company. Now, on this is the date, 1st September 2015. At that date, the fair value of Sequoia's company net assets, the fair value of the net asset of the non-current asset was 23,000, and this is the first of the adjustments. 23,000 greater than their carrying amount. So this is the first of the adjustment. So I'll show you how you do it. It's greater than the carrying amount. Then it means that they use the carrying amount and the fair value is greater than the carrying amount. And the balance on the retained earnings as at that day too was 21,000. The statement of financial position that ends 31st August 2016 is what we have below. So it says that there is also a revaluation, has not incorporated any revaluation surplus in the book. NCI is valued at full fair value method, which is deemed to be what? 18,000 at the acquisition date. I told you that when it's the fair value method, they will always give you. All right, so we have the balance sheet here. So you look at it. So the workings that we did, we will do. Now, when you finish the workings, you are going to prepare the consolidated financial position. And I want to use this example to show you, because when you are preparing the statement, consolidated statement of financial position, you do line by line addition. I will show you. I want to use this example to show you line by line addition. All right. So we do line by line. It's part of some of the things you do at the consolidated or the reporting date. So we have investment. So this is the balance sheet for Pine, and this is that for Sequoia. Now, when we say line by line, it means you are combining them. Don't forget, you are consolidating them. So PPE will be this one plus this one. But you don't just punch it on your calculator. You show it on the surface of the balance sheet. So I will show you how we do that. All right. So let's go on. So we've seen the balance sheet of the two companies. So we will be doing line by line addition when we get there. All right. So that is that. This is what we have. Now, so let's start doing what we need to do. What is the first thing we need to do? Yes. What is the first thing?
You have to determine the group structure.
All right, so workings 1, group structure. So let's determine the group structure together. So workings 1, group structure. Now, let me advise you. Let me give you this advice. In your exam, okay, don't try to do the workings and finish before you prepare the balance sheet. Don't do that. Don't risk yourself. I've told you time and time again that your answer booklet is 20 pages, which means that per every question, and you have 5 questions. So for every question, you need to use like 4 pages to answer one. So this one too, the same thing we learned when we were doing the publication question. Leave 2 pages for your workings and use the remaining 2 pages for your balance sheet. And if you also to prepare P&L, you do. Now, here, what you do is that the balance sheet, you already know a glimpse of it. So this is it. So what I want to tell you to do is to repeat the balance sheet structure, only that you are bringing in goodwill. That is that. So repeat it. So prepare the balance sheet before you even start the question. So let's do that. So go to your page. Please, these advices, take them seriously, because you save time a lot if you do that. You save time. Now, so let's prepare our balance sheet. We already know a glimpse of what the balance sheet looks like. So this is it. So what you do is that it's a group now. So you call it Pine Group, because Pine is the one that pitches the other one. So Pine Group. So you say consolidated statements of financial position. So don't do all the workings before you start. No, don't do that. Do it side by side. Financial position. As at, this one is 31st August 2016. So as at 31/08/2016. Then you underline. If you need to put 00s up, you do. Whatever you need to do, you do. All right. Now, so you start assets, NCA, put in your currencies. All right. I prefer balance sheet with only one currency. So you will definitely know that goodwill will come because you will do a working trade. So goodwill. Then the rest, just repeat everything you see. So PPE. All right. Then investments. Repeat everything, guys. Repeat everything. Then you have your current assets. You have here it is total assets. You have it here as total asset. So total, sorry, you have it here as current asset total. So you also do that. Then you come to the equity and liability. So you do that and do total assets. Then you can be leaving one space be there just in case anything comes for you to push something there. All right. So you do equity and liability. So here, what do we have? Ordinary shares. Then what do we have? Group retained earnings will come from your side. What you will be doing. So retained earnings. Don't forget it comes via your working sword 5. Then the NCI that you created, which is your workings 4, will also come. All right. So now you have your equity side. Then you have the NCL. Is there any NCL in this question? No. So we have current liabilities. All right. So that is that. You set it up. Please always set it up. Set it up. All right. Now let's now go back and start our workings. All right. So the group structure, how is it going to be? So the parent's name is Pine, right? So you draw down. We have. Okay. Now, what is the percentage of ownership?
75 on 20. 75%, 25%.
So NCI is CI is 75%. Then NCI will be what? 25%.
25.
Yes. What else do you do? What else do you do? And what is the date of acquisition?
You did that? 1st September.
1st September
2015.
2015. Now, then you come and look at the requirements of the question. You are supposed to prepare this thing, prepare financial statement, consolidated statement of financial position as at 31st December 2016. So from that 1st September to 31st August 2016, how many, the period?
12 months.
It's 12 months, which means 1 year, right?
Yes.
Yes, please.
All right, so you finish your workings 1. This thing you have done is acquisition method 1 and 2. So that is very important. You need to do that. Then workings 2. What is workings 2 about?
Net asset.
Please come again.
Net asset. Fair value of
Net.
net asset of the the NCI.
Subsidiary acquisition.
Okay, so fair value of net assets of sub. So who is the sub? So you put the name there. All right. At acquisition, at reporting, then what? Post acquisition. All right. So we start with stated capital, right? So when you write the stated capital, you go to the balance sheet of the subsidiary. Stated capital is 20,000. So this is the reporting date. So you put it there, 20,000. But like I told you, as for stated capital, it's the same thing. It doesn't change. So 20,000. So you see that the movement is 0. So here, focus on the equity and the equity part of the subsidiary. So what else do we see here? After the stated capital, just focus on the equity part of the subsidiary. What else do we see? This is the subsidiary. So this is the stated capital. The next thing we see there is what? Retained earnings. So what did the question say about retained earnings? So we know the retained earnings at reporting. Here, the reporting date. Retained earnings is 41, so 41,000. But what is the retained earnings at acquisition date? What is the retained earnings at acquisition date? Do you have any idea where we can find the retained earnings at the acquisition date?
21,000.
21,000. It is given in the question. Yeah, at the date. So 21,000. So the movement is how much? 20,000, right?
Yes.
20,000. All right. So that is that. Now, if you check the format, we had things like goodwill at acquisition, we write it off and all those things, PAPs and all those things. We've not seen the face of that in this question yet, but there is one of them, which we call the fair value adjustment. The fair value adjustment. If you read this question carefully, you realize that they said that at the date of the acquisition, the fair value of Sequoia's non-current assets was 23,000 greater, which means that this aspect wasn't factored. It wasn't factored in the determination. So we need to adjust it. So like you saw in the format, 23,000, 23,000. See, if the question has said it is lesser, then we would have to put this thing in bracket. All right. So take note of that. Now, we do the fair value adjustment depreciation. That part was omitted, and we have now included it. And the depreciation too that was omitted, we are now doing it. So, per the question should normally give you the depreciation adjustment, how it should be done. If the question doesn't give you, then it means that glory, hallelujah. But every asset suffers depreciation. Take note of that. Every asset suffers depreciation or revaluation. So here we need to find out, since the question is silent, that it didn't actually give us the way we should go about the depreciation, then it means that we are also not to do anything. But most of the time, you check what the question says about what you should do about the fair value adjustment depreciation. So it will tell you that, oh, okay, that fair value adjustment depreciation that you have there is supposed to be depreciated over 3 years. Then that is where you need to always multiply it by. So if you do the depreciation per year, then you multiply it by the angle, the period that you have in here. So you look around, look into the question. If they actually gave you how you should go around the fair value adjustment. So always look out for that. If this question, for example, I think is so silent, there is nothing like fair value adjustment depreciation. But let's check well. Maybe there is not. Okay, maybe there is not. All right. So, but all the time there has to be, okay, most of the time. So it tells us that at the date they had, which is exceeding, and they also give us this one that we have here. Okay. All right. So we go on with the question. Is there anything? Look at this. If Sequoia had revalued its non-current asset at what do we call it? That 1st September, an additional 3,000 would have been made to depreciation for the year. So if they had used the revaluation, which is the fair value, an additional 3,000 would have been made. So this one speaks to what we call the fair value adjustment. So always look out for it. All right. So this one, they gave it to you directly. So it means fair value adjustment depreciation is what? 3,000. Always look out for it. And please, it's the subsequent measurement. Depreciation is subsequent measurement. So you don't put it at the date of acquisition. You don't depreciate asset the day you bought it. So it's common sense. It's common sense. It's not about a format. It's standard sense. All right. So now, we can now total our figures now, because these are the only things. We are building up, so we start slow, okay? So when you total decide how much will you get, total decide how much will you get. I think here is 17,000. $41, 64.
Before.
And what about this side? The same 64 minus 3. Hey, sorry. This one is 81. This one is 41. So 81,000. Yeah. So the difference, the movement should equate. All right. It should always equate. All right. We are done with our workings 2. Don't forget, we will need this figure for our workings 3, and we will have to be splitting this one too. Okay. So that is that. Then we come to our workings 3. Now, when we finish the goodwill computation, we zoom into doing our balance sheet. Fast. We zoom there. Okay. And don't forget, these are adjustments that affected NCA. So all these reporting issues, adjustment here, will affect our balance sheet preparation. Don't forget that. All right. So let's do goodwill. Let's do goodwill. Okay, what do we need for goodwill? Purchase consideration, right? Fair value of purchase consideration. Now, how much is the purchase consideration? How much are they paying for? They are using, so how much are they paying for? You go back, you see the question. This 75, how much did they buy the 75? How much did they give out for buying the 75? We need to find out. So they bought this at the date, they are carrying amount, blah, 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 and we need to find the acquisition value. Now, if you don't see it in this statement, go back and see in the parent balance sheet. So you see that they said that they bought it. They bought Sophia, Sequoia, like 51,000. So that is where you find it. So 51,000. All right. So immediately you go to your balance sheet. You go to your balance sheet, investment. You will do what was there before. It was 51,000 before. And that is what they used to buy that subsidiary. So you've seen it in your purchase consideration. So the double entry for the purchase consideration is that debit purchase consideration, credit the investment. So we take the investment out. It's the same 51,000. So here will be 0. All right. So that is that. Let's go back. Continue with our goodwill. Let's find our goodwill and come and insert. All right. So purchase consideration we have. What is the next thing you bring? Yes. What is the next thing? Yes. The format we do.
Then the share of NCI at acquisition.
The share.
Yeah.
No, it's not the share. Look at it well. It's not the share. We are not doing NCI. We are doing goodwill. This is working straight.
Yes.
So it cannot be the share of NCI at acquisition. Kindly check it well. So that is why I stress on the fact that look at the format, you will come to it. So don't mess it up. Please, that thing is very, very crucial. Don't mess it up. Don't sit in the exams as if you don't know what you are about. This is it. It's clear. So there's nothing like share over here. It's NCI at acquisition. So please practice it so that it will be on your fingertips. You have 1 week before we meet again. If you practice, fine. If you decide not to practice, that one too is fine. All right. So we know what we need. It's NCI at acquisition. So it's either at fair value or proportionate. This one, is it fair value or proportionate?
It's proportionate.
Yes. Hey,
proportionate.
On what grounds are you saying proportionate? When do you use proportionate? Guys, it is very not good to say something before you think about it. No, don't do that. Think about it before you say. Get facts before you talk. Don't talk. Then when you are asked to find a reason, no, it should be the other way around. All right. So if we ask you a question, process the question. Just ask yourself, okay, so per what we've been discussing, when do we use, we have 2 methods. When do we use this one? I told you that when it is fair value method, the examiner will give it to you, right? Are you there?
Yes.
Yeah. So please, we are learning. So process the things. And unless you didn't pay attention when we were doing that, that is it. That one will be a problem. And why will you also decide to join a class but not pay attention? Then don't join class. Okay. So you see here that here it is the fair value. It says that NCI is valued at full and it is deemed to be what? 18,000 at the acquisition date. So if you are asking you NCI at acquisition date, you shouldn't do guesswork. Okay. So here is 18,000. All right. Then the next thing you do is to less fair value of net assets at acquisition. How much is that one?
64.
All right. So it's coming from your working to you less 64. All right. So that is that. So what will be your goodwill at acquisition? So you less impairment. I don't think this question there was impairment. There wasn't impairment, so impairment will be 0. Therefore, the same thing will be our goodwill carried down. All right. So what is the figure for our goodwill?
5,000.
It's 5,000. Okay. All right. So 5,000. So immediately you can go to your balance sheet and insert your goodwill. All right. So go to your balance sheet. So goodwill. Because if you don't do that and it says stop work, you have nothing. So let me put this there. So goodwill is 5,000. All right. So you put that there. That is workings 3. All right. You put that there. Now, so the next thing is to do our workings 4. Is that not it? So let's do our workings 4. Workings 4 is about the NCI. That is where probably when you talk about your share, you can bring it in. So we start with NCI at acquisition. What is the NCI at acquisition?
18.
How much is the NCI at acquisition?
18.
18. All right. Then what do you do again? You bring in what he said. This is where you do the share. You share things. So NCI share of the post app. Please practice, okay? Practice so that your hand will know the next thing to do. Okay, if you don't practice, you'll be fumbling. Practice it. By the time you solve like 2-3 questions, you know that, oh, okay, every time I'm doing this, these are how it goes. If you don't, please don't expect results. All right. If you don't expect results. It will be frustrating to your own soul because you are not fulfilling the condition of seed time and harvest time. Anything that you do that is outside the seed time and harvest time will bring frustration to you. Yes, it will. That one is a natural law. I believe in the Bible. So when the Bible says that, thinking in Genesis chapter 8:22, it says that as far as the earth remains, seed time and harvest time shall not cease. So if you don't do the seed aspect, please don't expect the harvest aspect. You will just be frustrated, unfortunately. That one there, I can guarantee you that. All right. Okay. So now, okay, so let's wait for this thing to leave the screen. So what is the NCI share of the post-acquisition profit? So you will use the NCI percentage. What is the percentage? What was the NCI percentage?
25%.
So 25% multiplied by the acquisition. We have 17,000, right?
17.
Yeah, so do it and give me the value, 17,000.
4250.
50.
4250. All right.
4242.
4250.
Yeah.
Okay, so that is that. Then if there is impairment, we less. But in this case, I don't think there is any impairment in the question. And there is no attributable goodwill, there is no preference here. So we end it here. We are building ourselves. So those of you who have the manual, do it progressively, all right? You get there before we even meet. Okay, so what is the total? So it will be 22, right? 250. All right, then let's do the last working. So you see, you have your NCI carried down. So the NCI portion that you created inside the balance sheet, you can fill the space fast. So this is it. So we have 22,250. So you can fill it. Coming from your pin score is 22. Is it 22? Was it 22 or 24?
22,250.
22,250. All right, that's fine. Then let's go to our workings, the last workings, the workings 5. Then we fill in everything. I'll show you the balance sheet when we mean line by line item, addition line by line. So we do group retained earnings. Where do you start with? What do you start with?
Start with the parent.
So the parent own, which is the full 100%. This is the parent financial statement. And so this is, where is it? It's 96,000. Okay. So that is what we have, 96,000. Then the CI share of the post-acquisition. All right. So what was the percentage of the CI? If this is 25, then that one would be 75. So you are sharing the 17,000. All right. So that one gives us, so the remaining, the 17,000 you shared, the remaining comes here. All right. So how much?
12,750.
All right. So that is that. Now, we don't have any impairment. We don't have any unwinding. We don't have all those things. Gain on back gain hasn't happened yet. So what will be the total here? I think here will be 8, here will be 10, then 750. All right, so 10, 108,750. So we go to our balance sheet, that aspect too, we put it in there. All right. So we have 108,750. Now, the stated capital, you pick the parent own. All right. So the stated capital, the parent own, what is there is 80,000. Don't forget the subsidiaries own, we use it as part of determination of the workings too. All right. So that is that. Now, the assets and the liabilities are added line by line. What do we mean by that? Line by line, the asset and the liabilities. So when you take the PPE, for example, you need to show it in these brackets. The PPE for this man is 63,000, right? Plus the PPE for this is what? 28. So you show it like this, 28. Now, when you are done, then you work the adjustment. Don't forget, when we were doing the workings too, there were some adjustments, and the adjustments were at reporting date. So this is balance sheet at reporting date. Have you seen this? The NCA adjustment. So 23,000 is here. Then there's 3,000 depreciation. So you add 23,000 and you will less the 3,000 to your NCA. So whatever it affects, if it affected inventory, you do it against inventory and so on and so forth. If it affected receivables, the same thing. So plus 23,000 minus 3,000. So that is that. How much will you get? How much will you get? Then the CA, current assets, this man's own is 82,000. So you show it. Don't just punch it on your calculator and write the final answer. If you do, you are wrong, because that is not what the standard says. All right. So this side, he has 43,000. So let's add them and see. The same thing for the current liability.
PP is
So
111.
PP is what?
111.
111,000.
Yes.
All right. So that is fine. Then get me the CA. As we also look at the current liabilities, which here is 20,000.
125.
Which
CA.
one is the one? Right, the CA 125.
125.
All right. Then we can total, right? Total asset. Please don't forget at this level, we do IAS 1. It says asset is equal to capital plus liability. All right.
241.
It's what? 241.
241.
241,000, right?
Yes, sir.
Okay, so here is 20,000 plus what? 10,000. So that one gives us 30,000. So let's see if you balance.
Balance. 241,000. Yeah.
241,000. So ladies and gentlemen, this is how you perform your consolidated balance sheet. Now, see, the only thing that will happen going forward is the fact that you will see your current asset will be open. So you have inventory, receivables, and cash and bank, but it's the same principle. You add them. Okay. Your liabilities too can be open. All right. And you may have some NCL too. It's the same principle. What we will be learning next week is what we call the adjustment. I call them the examiner's tricks. So we will look at the examiner's tricks, that which you would try to use to deceive you from getting certain things wrong. But since you have this fundamental right and you have your format, it's the same thing. There are 5 areas the examiner will always try to trick you. 5, but all the 5 doesn't come in one question. Okay, you may not get all the 5 in one question. Now, he will trick you about 4 of them or something. So when we meet another time, we are going to discuss the exam tricks of the examiner, and we will look at them. The first one is the purchase consideration. Now, you saw that when we were doing the workings 3, Goodwill, we start with purchase consideration. But the truth is that there are about 4 ways the purchase consideration can happen. So we will look at each and every one of them, 4, so that whichever one the examiner will bring, we will pick up, we will know how to use. This one that we did, I think it was cash. So you saw it straight away. So you saw it here. All right. So that is that. So we will learn about it. Number 2 trick is that, you see this one, they purchase the thing, the timing between the year, the date of purchase and the the reporting date was 1 year, but sometimes it can be mid-year. So what do you do when it is mid-year? It is purchased somewhere in between the year. We will learn that one too. Trick number 3, which we don't normally see it, is what we call the uniform accounting policy. It doesn't happen most of the time in the exam. So what is that about? Maybe I am the parent. In my place, I use straight line method to value the depreciation of my asset. But the company that I want to buy is using reducing balance. So my straight line, they are reducing balance. We can only prepare consolidated financial statement if our policy is the same. So I need to convert their own to reducing, to also to straight line. When I do that, changing from straight line to reducing balance to straight line will bring about some differences. All right. Don't forget that is a change in estimate. So we will adjust that difference in our workings too. All right. Then number 4 is what you saw today. All right, is the fair value adjustment. You saw one today. It was about the NCA. All right, you saw one today. So you put the figure there. You also did the fair value adjustment depreciation. But the next time, it may not be on the NCA. It may be on receivable. It can be on inventory. It can be on anything. All right, so you need to learn that. If it is about an intangible, you know that subsequently the intangible is amortized or it's impaired. All right, so you do that fair value adjustment, depreciation, impairment, or amortization. So you will look at that again. Then trick number 5, this is where everything comes to play. We call it the intra-group transaction. So that intra-group transaction is whereby one sells to the other, and in those things, the kind of thing that will be happening in there, we will talk about cash in transit. All right, we'll talk about cash in transit. We will also talk about inventory in transit. Okay, how do you do that? Inventory in transit. We'll talk about provision for unrealized profit, the PAPs. Yes, we'll talk about the PAPs, whether it is inventory PAP or the PP PAP. We will talk about that. Then we will talk about interest and dividends. Interest and dividends. All right. When they pay dividend, how will we do it? You cannot pay yourself. So we will erase that. Then the last one will be the intra-group loans. Okay. So these are the areas of the examiner's trick we will use that, whether it is basic consolidation or complex consolidation, these are their tricks. So we will learn all these things and we will get ready for the exam. So this is it, and you've done well because it's your first time of encountering something we call consolidation, even though some of you weren't able to kind of arrange the things under the various working, but it's normal. Why? Because we just did it today. There are some of us in our learning curve, we need to go over again. So why not? If you know how you are, just go over again and try 1 or 2 examples again before we meet. All right. So that one will help. So you see all those examiners tricks are in here. I've talked about it in your book, your manual. So you have the opportunity to look at them. For every adjustment or every trick, I give a whole example for you to practice. So you will practice it. And whenever you finish the practice, you go ahead to solve a main question. So with every step, there is a main question. So you fix it in, then you balance it. With every adjustment, with every trick, once I treat it, I give a question. So you balance it. So by the time you go through the process, you realize that you have become perfect. So if I were you, I were you, I would just take my manual, look at the first trick, learn it, read it, and I give example. So once you are done, then you look at a full question on it. By the time you look at all those tricks, you are well able to answer a whole full big grown question. All right. So ladies and gentlemen, this is where I draw the curtains. If there is no question, if there is a question, I'm open to answering. All right. All right. So in the absence of any question, God bless you and have a good rest. We will meet next week. I think we will meet Sunday. Yes, please.
Sunday.
Yes.
Okay.
For earnings per share. All right. Any other question?
Sunday around what time?
It's 6 o'clock. Why you've not been seeing it? Who is that?
This one.
Oh, so you've not been joining the Sunday class?
I joined only once. That's all.
Oh, okay. So the same time.
Okay.
All right. Thank you very much, class.
Okay, thank you.